Now that we have a solid grasp on the things that go into a company's financial statements, it's time to dig into them to really get a feel for what's going on with the business. We need to do some analysis. Financial statement analysis is all about telling the story of the company. If the financial statements are just a pile of numbers, the analysis we're going to do here allows us to put together an easily understood narrative. We should be able to identify what the company's strengths and weaknesses are. Are they getting better or worse as time goes on? How are they performing relative to their competitors? With this story we put together, we should be able to make better financial decisions. A lender at a bank will be able to do a better job determining who should get a loan and who shouldn't. A manager will be able to pinpoint trouble spots in the business that need improvement. And stock investors can make better investments by getting a clearer picture of what companies are underperforming and which companies are overperforming. With financial statement analysis, we're going to be working with lots of accounting data and terminology, and we're going to be working with ratios. But I want to encourage you not to get wrapped up in the math and accounting. I'm going to try my best to get you to think and be able to explain these concepts to others in plain, simple language. As I just said, we're going to be working largely with ratios here. Why ratios? Well, ratios make it easier to make comparisons against things that would otherwise be incomparable. Let's look at GDP as an example. We have two countries here, Brazil and Spain. Looking at the raw GDP numbers, we would think that Brazil is a bit wealthier than Spain. But this isn't the case. It's not a fair comparison. It's like comparing apples and oranges because the two countries differ greatly in size. Brazil has a population of 209 million, whereas Spain has a population of only 46 million. To make a more relevant comparison, we can create a ratio, GDP per capita, which is GDP divided by population. With this ratio, we can see that Spain is actually the wealthier country. Its GDP per capita is $31,000 compared to just $8,900 for Brazil. We're going to be dealing with financial ratios in this section, and these ratios can be divided into categories which describe different aspects of the business. We'll start with liquidity ratios, which look at a company's management of its short-term resources. Then asset management ratios, which will look at how efficiently the business is using its assets it has. Debt management, it's going to examine how the company gets its funding. Profitability ratios will look at how effective the business is in generating profits. And finally, market value ratios will examine what outside investors think about the company. Together, we can compile a clear view of the condition of the business and make more informed decisions. We need some financial statement data to put these ratios together, so we're going to use E Corp as a sample company. We have their income statement here, as well as their balance sheet. Let's begin with liquidity ratios. The word liquidity just means how quickly and easily we can turn something into cash. So these ratios will compare a company's liquid assets, things we expect to generate cash for us in the short term, against its liquid liabilities, things we expect to have to pay off with cash in the short term, where short term is defined as less than 1 year. Two common liquidity ratios are the current ratio and the quick ratio. The current ratio puts the company's liquid assets, their current assets, in the numerator, and their liquid liabilities, the current liabilities, in the denominator. Imagine this ratio being smaller than 1. What would that imply? In order for the current ratio to be less than 1, current liabilities have to be greater than current assets. That means that the company has more things they must pay off with cash in the short term than assets that will bring in cash in the short term. On the flip side, a current ratio greater than 1 implies that they expect to bring in more cash in the short term than they expect to pay out. So broadly, this ratio will tell us whether the company is in a good position to meet its short-term obligations or not. Related to the current ratio is the quick ratio. The quick ratio is just a more stringent version of the current ratio. We still have current liabilities in the denominator, but in the numerator, we take out inventory. We remove inventory because even though it's technically a current asset, it's not that liquid. Inventory is inventory for a reason. We haven't been able to sell it. So the quick ratio takes into account only the most liquid of the assets and leaves inventory out. In general, low liquidity ratios are a sign of trouble. If a company consistently owes more in the short term than they expect to bring in, then that could be an indication that they're struggling just to stay afloat. On the other hand, a very high ratio isn't necessarily a good sign either. Imagine the current ratio being a very big number. What is that going to imply? It means that the company is investing a lot of resources into current assets. Cash, for example. While they would be less likely to run into financial difficulties, they're also missing out on productive investment opportunities that could generate better returns for them. Let's look at E Corp's liquidity ratios. We pulled current assets and current liabilities from the balance sheet to find a current ratio of 2.58. Similarly, we can compute the quick ratio by adjusting for the relative illiquidity of inventory and get a quick ratio of 0.93. Now, how can we interpret these numbers? A common theme with all the ratios we're going to compute is that one single ratio is pretty meaningless by itself. It only gains meaning once we use it to make comparisons. So let's do that. Let's put the ratios in context. Let's first do a trend analysis. How has E Corp's liquidity changed over time? Is it trending up or down? We can see that both the current and quick ratios are steadily improving over time. A good financial analyst could go a step further and dig deeper into figuring out why these are improving. We could also do peer group analysis and see how E Corp stacks up against its industry competition. We can see that they're a little below their peers, but they don't deviate too far in 2018. The operating cycle looks at the concept of liquidity from a different perspective. Liquidity looks at how quickly we can turn something into cash, while the operating cycle asks, how quickly can we turn the business's production process into cash? We're going to time the entire process from acquiring raw materials to getting cash from customers. It's going to have two components. Days sales and inventory, which is going to measure the time to transform inventory into a sale. And days sales outstanding is going to capture the time it takes to collect cash from the sale. This diagram here summarizes the operating cycle. We want to see how many days it takes to complete one revolution of the cycle. Our starting point is going to be getting raw materials, then creating inventory, then selling that inventory to customers on credit. This portion captures the days sales and inventory component. The remaining time will capture the time it takes to get cash from customers, days sales outstanding. Pulling information from E Corp statements, we see that their days sales and inventory is 89 days. It takes them on average 89 days to turn inventory into a sale. Their days sales outstanding is 46 days, which means on average, it takes 46 days to collect cash from customers. Putting the components together, they have an operating cycle of 135 days. That's the length of time to complete one full cycle of the entire production process. As with all ratios, there's little meaning to them unless we put them in context. Is 135 days good or bad? Let's do some comparisons to see. On a trend basis, it appears that E Corp is going in the wrong direction. It's taken them longer to turn inventory into sales, going from 80 days in 2017 to 89 days in 2018. Similarly, it takes them longer to collect cash from customers, going from 39 days to 46 days. Although the operating cycle increased between 2017 and 2018. Altogether, the operating cycle increased between 2017 and 2018. It's taken them longer to turn the production process into cash. They're also doing a poor job on every dimension relative to their industry competitors. This analysis identifies areas for E Corp to improve. Maybe E Corp can impose stricter standards on customers to get them to pay quicker, or maybe they can train their sales staff to sell inventory quicker. Something should be done to get them on the right track. The next set of financial analysis tools we can work with are the asset management ratios. These asset management ratios will tell us how efficiently the company is using their assets to produce sales. A handful of asset management ratios are presented here. I'll go through each and try to translate each one into what they're telling us. Inventory turnover is going to tell us how we're managing our inventory. Try to imagine E Corp having a warehouse somewhere. Inventory turnover is going to tell us how many times per year this warehouse gets filled up and then emptied out. The bigger this number, the faster they go through inventory. Looking at the ratio, a company can have a big inventory turnover for a couple of reasons. It could be because their sales are high, so stuff just flies quickly out of the warehouse. Or it could be because inventory is kept low and they have to resupply often. Related to inventory turnover is accounts receivable turnover. This is going to detail how many times a year we collect on credit sales from customers. This one's a little hard to visualize, but let's try anyways. Try to imagine an account that gets filled with credit sales to customers. The account fills up, and then we empty it by collecting cash from customers. So accounts receivable turnover is telling us how many times a year that process happens. A bigger number implies that they're quickly collecting cash. We've already seen the next two ratios before, days sales in inventory and days sales outstanding. We saw them in a different format in our discussion of the operating cycle. They provide the same information as inventory turnover and accounts receivable turnover. They just present it in different units, days instead of the number of times per year. You can play around with these ratios to see if the math checks out. The last two ratios here are fixed asset turnover and total asset turnover. Fixed asset turnover looks at how well the company is using its fixed assets, that's its plant, property, and equipment, to generate sales. The larger this number, the more efficient the company is in generating sales from its fixed assets. Try to imagine a ratio of 10 for this number. That means they're able to generate $10 of sales for every dollar of fixed assets they have. Now imagine fixed asset turnover goes from 10 to 20. That implies that now, instead of just generating $10 of sales, they're able to generate $20 of sales with the exact same assets. That's what we mean by efficiency. Total asset turnover is almost identical, except instead of looking just at the fixed assets, we're considering all the company's assets, fixed and current assets like cash, inventory, accounts receivable, etc. The interpretation of total asset turnover is the same as fixed asset turnover. Instead, this time it tells us how efficient we are in using all of our assets to generate sales, not just our fixed assets. Looking at E Corp, we can see that their fixed asset turnover has been trending upwards over time. They're becoming more efficient in using their fixed assets to generate sales as time goes on. And in 2018, they're more efficient than their industry competitors. However, total asset turnover isn't looking as good. They're becoming less efficient in using their total assets to generate sales, and they're lagging behind their competitors. Ask yourself this question: what does it mean if fixed asset turnover is improving, but total asset turnover is getting worse? Well, what's the only difference between the two ratios? The difference is total asset turnover includes current assets. So the fact that the ratios are moving in opposite directions suggests that efficiency in managing short-term assets, or our current assets, is the problem. We can see here that in the inventory turnover here. Inventory turnover is trending downwards, meaning E Corp is becoming less efficient in using its inventory to generate sales. Maybe they have old inventory that's difficult to sell, or they may be storing too much inventory in their warehouses. Something is going on here that warrants further investigation. I'll stop here for now. There are a couple more categories of ratios to go. In part 2, we're going to finish up by going over debt management, profitability, and market value ratios, as well as going over some of the limitations that come along with ratio analysis.